Japan is Australia's second largest trading partner after China, and this relationship has an impact on the exchange rate between the two countries. In the past 18 months, 1 AUD to the Japanese yen has declined from 102 to 80 yen, which means that one Australian dollar could have bought 120 yen, but today can only buy 80 yen. In the past, there has always been a trade surplus between Australia and Japan, driving the AUD to appreciate against the Japanese yen. Japan will have to buy more AUD, increasing the demand and strengthening our currency. We forecasted that the AUD to the Japanese yen exchange to appreciate over time on the long term. Currently, the commodity price of Australia has been on an upward trend. Higher commodity exports result in foreign countries like Japan having to buy larger amounts of Australian dollar in order to purchase commodities. This in turn will increase the demand for the Australian dollar and result in an appreciation of the exchange rate. Therefore, when Japan purchases high commodity prices past Australian exports, the AUD will appreciate against the Japanese yen. Furthermore, the strong relationship between Australia and Japan is further improved by the Japan-Australia Economic Partnership Agreement, which allows either party to trade without tariffs or trade barriers. This in turn encourages Japan to purchase more Australian exports, further strengthening the demand for the Australian dollar, and again the Australian dollar will appreciate against the Japanese yen.
The second currency pair being examined in this assignment is the Australian dollar against the US dollar. The first economic indicator used is the relative interest rates. The current interest rate for the US is 1.75%, which is an increase from the previous rate being 1.5%. The traditional view is that an increase in interest rates would have the following effects. Encourages capital inflow, therefore increasing demand for the US dollar, and discourages capital outflow, therefore decreasing supply of the US dollar. The Australian interest rate currently stands at 1.50% and was last changed in July 2016 with sourced from tradingeconomics.com from a rate of 1.75%. This figure is lower than Australia's previous interest rate and America's current rate of 1.75%, showing a decrease. This therefore implies that the government is encouraging consumer spending in Australia due to the increasing supply of the Australian dollar. Therefore, in the foreign exchange market, the Australian dollar is expected to appreciate against the US dollar due to the decreased supply of the US dollar and increased supply of the Australian dollar. This is further supported by the graph below. This shows an increase in supply from the US dollar, a decrease in supply of the US dollar, and an increased demand for the US dollar. The second economic indicator examined is the relative GDP growth rate. The current US growth rate is 2.9%, which is a decrease from the previous rate of 3.2%, meaning that the US economy is growing slower than it was previously. The same thing can be said for the Australian growth rate, which is currently at 0.4% compared to its previous quarter of 0.7%. This is due to the increased offshoring and outsourcing of industries. Example, in Australia, the manufacturing industry declined by 1%. An effect of lower levels of economic growth is a decreased demand for imports. This will decrease the supply of the US dollar and shift the curve to the left. Another effect could be the level of overseas borrowing. This will decrease the demand for the US dollar and shift the demand curve to the left. When comparing the two rates, the US has a higher growth rate than Australia. This implies that due to the faster growth rate, there will be a higher supply of US dollar in the foreign exchange market, and which will result in its depreciation against the Australian dollar. The next economic indicator examined is inflation rates. The United States has a higher inflation rate of 2.4% than its trading partners Australia, 1.9%. meaning that they will experience less demand for exports and therefore less demand for the US dollar, and more demand for imports and therefore more supply of the US dollar. For this currency pair, that therefore indicates that the US dollar will depreciate against the Australian dollar in future trading. That therefore concludes the presentation. Okay, done.